If you're buying a condo right now, there is a form that your lender has to fill out that could absolutely kill your loan, and most people have not heard about it. When did this law come into effect?
This is big.
Yeah.
So this one's big. Hi, I'm Matt Carrell.
Yes, Matt is a lender that we work with. We love Matt. And Matt, who are you with now?
I'm with Guaranteed Rate Affinity, and we're in every state in the union, so we've been around for a minute. But this new regulation that came out for how Fannie Mae and Freddie Mac underwrite and okay a home loan on a condo, you haven't heard of it yet. It just went into effect on August 3rd. Fortunately, some of the things are being kind of gradually ushered in, and the next one might be January 1st.
Okay.
So your HOA has time, and if you're trying to buy one of these condos, you may think that you've got a perfect condo that you can buy, but it may not meet Fannie and Freddie's guidelines. So
what are the new guidelines? Because that's the form they're filling out. They're filling out the condo questionnaire. And what are the new things that have changed that could really ruin a deal?
So just backing up a little bit, big picture, anytime you buy a condo, and this has been going on forever, I'm going to underwrite both your qualifying as a borrower, but also the condo itself. So if you remember, there was a condo that just completely collapsed last year in Florida.
Oh, yeah.
Remember that? So the whole thing just fell apart basically because this HOA deferred maintenance over years and years and years. Fannie and Freddie are acknowledging A, the fact that HOAs are not taking care of their properties, and B, insurance is getting really, really difficult on these homes, right? So the thing that you want to look out for, or at least be aware of, is that the way that Fannie and Freddie have changed things is that they're requiring these master insurance policies to have lower deductibles per unit. Now, in the world of insurance,
with insurance right now.
With insurance, lower deductible means higher premium. Higher premium means
higher HOA dues.
Higher HOA dues. Not fantastic, but there's other regulations that have actually eased things a little bit to help out with monthly payments, HOA dues, and those kinds of things, which is great. But you really need to be aware that the master insurance policy has to be up to date today. There's no delays anymore. And that, what do I call it? Deductible, that deductible must be up to speed. Now, if it's not, that insurance, that HOA, all of these HOA boards right now are scrambling to get their insurance policies correct.
Well, I'm sure it's been with you or another lender where you're waiting on the master insurance policy. Like I've been there where they're like, oh, because they have to approve it. So it can't just be like, oh yeah, let's change it. It has to go to the board. The board has to approve it, and then it has to go into effect. So it's not just like a quick fix, but we've definitely in the past been able to kind of let it slide. That's not happening anymore.
That's right. That's a really good segue to the next thing. And first of all, master insurance policy is basically the insurance policy that covers the exterior of the building, right? So if you buy a condo, you're required to get walls in insurance. So basically you're insuring your unit, but because your unit shares walls and roofs and stuff like that, you have to have this master insurance policy that takes care of everything in case something happens.
And that's part of your dues. So when we're looking at dues, I tell people a lot like, hey, if it's covering your exterior maintenance and your roof and all these things, it's a decent price, right?
That's right. So yeah, your insurance policy as an individual, the HO6 policy, the walls in, is usually relatively inexpensive.
Totally.
So when you combine that with your HOA dues that feel so high, that's actually just your insurance premium that's impacting those HOA dues.
Correct.
Yeah. So what Amber mentioned about being able to, before, just kind of ignore that master insurance policy is previously, if a borrower put down 10% or more for down payment, we could do a limited review.
Yeah.
Which is just like, okay, yeah, that looks pretty good. So we can't do that anymore. There's no more limited review. Every single loan has to go through a full condo review, which also includes the HOA budget.
Yes.
This one's another really challenging. Now, this is the one that's going to be delayed till January. So that's good. Yeah.
That's good. Yeah. It'll give them some time.
Yeah. So what Fannie and Freddie want is they want to make sure that the HOA of your condo has a full reserve.
Yep.
So the full reserve is sitting there just in case there is like this massive hailstorm that comes through,
Mm-hmm.
and now we've got a claim, and we have to pay our deductible first. Well, they're going to pull from those reserves.
Yep.
Otherwise, they're coming to each individual homeowner,
And they're going to put an assessment on your unit.
That's right. So the requirement, the financial requirement, is that the reserve requirement used to be 10% of what your total HOA income was for the year for
Okay.
all units. So let's say you're a big unit or a big you're a big project and you're bringing in $150,000 a year in HOA dues. Well, you would have to hold 15% of that, or 62.5. Is that right? No, 22.5. 22.5 in reserves, just sitting there. Well, that number used to be 10%. It's now the 22.5. It used to be 150.
Ooh.
Now it's 22.5. So what that all means is that the HOA is being asked to be more financially stable.
Which they should be.
Yeah, they should be.
They should be no matter what. So
That's right.
I don't hate it. It is just going to make it harder for a chunk of them to get up to speed.
That's
So
right.
what are I'm glad that that's not going to until December,
January.
What are they going to do, these HOAs that don't have that reserve? They're not going to
No.
be lendable.
They're not going to be lendable. So it's called a non-warrantable
Yep.
condominium. So non-warrantable means Fannie and Freddie, we as a lender will look at everything. We'll look at the budget. We'll look at the insurance policy, and we will say, hey, you don't meet X, Y, and Z on these things. And buyer, you're 2 weeks into your purchase contract.
You can't buy it.
You can't buy it.
Yeah, and non-warrantable, we've dealt with that in the past, and most of the time the non-warrantables are the ones that are in an active lawsuit. Because
That's right.
lenders don't want to lend on them if they're currently in a lawsuit because they don't know what the outcome of that lawsuit is going to be. So if that's the case, only a cash buyer can buy those because lenders will not lend on them. So that's a big deal.
It's a huge deal. I'm going to give myself a little bit of a marketing pop here.
Please do, because what you told me is it's good.
So
It makes you different.
That's right. So at Guaranteed Rate Affinity, we do have 3 investors. They are they're portfolio loans. And don't get scared. A portfolio loan used to carry this stigma of having a very high interest rate. These portfolio loans, they might be a quarter of a point higher than a Fannie or Freddie product.
But if you closing or not closing, doesn't matter.
All day long, right?
All day long.
So, and I don't want to discount. I know that things are expensive right now, but if it means getting you into a home, then it is worth the buy.
It is worth it.
Yep. Now, what our investors and portfolio loans will allow you to do is, now you have to have kind of an extenuating circumstance, or at least combined, I don't know what you would call it.
Dominoes.
Yeah, so let's call it dominoes. Let's say your master insurance policy fails.
Okay.
Master insurance policy fails the Fannie Freddie requirement. These portfolio lenders will say, that's fine. We want you to add a rider to your personal insurance policy that protects you against future assessments.
You should always add this assessment rider. So we've had plenty of buyers that have bought condos. I always say you should add the special assessment rider. It's usually between $20 and $40 a month, but anybody that's had that, if it's an act of God, which is usually the term for that special assessment rider, then if the condo complex assesses your unit for, let's say, $6,000, then you only have to pay the deductible for that.
Yep. So this happened to me personally. We've got a couple
yeah.
of investment property condos. 2 years ago, big hailstorm came through Aurora.
Mm-hmm.
2 of those properties got hit with a roof deductible. It would have been, I think one was $7,500 and the other was $8,000. That would have cost me $15,500, and all I had to do was pay my $1,000 deductible for both. I'd rather not pay anything, right?
But that's a big deal, and so you should get that anyway. But this lender, this portfolio lender, if you have that rider, it'll just say that's
Correct.
okay if the policy's not that good.
Correct. They will lend on that condo with the combined master insurance policy. And now we do like to look at these on a case-by-case basis, but I've yet to see
there's
one
qualifiers.
I've yet to see one not go through.
That's huge.
So it's big. And this is kind of where the lending world is going, is that there are outlets through the right lenders that you can use to get financing when you otherwise may not be able to.
Definitely.
So it's kind of like some make sense lending policies, which we really desperately need. Yeah.
Well, we need that.
Yeah. True.
It's going to be interesting seeing how these HOAs are going to get up to speed, and if they can.
100%.
To be able to sell. It's hard enough to sell a condo in this market because it's hard for people to understand the HOA dues, and if you're not bringing 20%, so you're talking about HOA dues and then potentially MI insurance, mortgage insurance, and then your monthly pay. I mean, it can get expensive to buy a condo.
Fortunately, condo prices are at a level that,
oh my gosh, they're the best they've been in years.
Yep. So there is opportunity there to get into a lower price,
Absolutely.
Purchase price. And for investors, one more thing I want to add.
Yeah.
Previously, Fannie and Freddie would say, okay, you are an investor. I want to buy a rental property.
Oh, yes.
And the project that I'm interested in has more than 50% investors who own those properties. Before, Fannie said, nope, can't have more than 50% concentration of investors in those properties. They've now waived that completely.
Really?
So, completely. So if you're now an investor, go to town, man, because there's value out there, and there's no investor concentration maximum for condominiums.
That's huge.
It's big. It really is.
It used to be 50%.
Used to be 50%.
Most of them, or was it all of them? 50%?
It was all of them.
All of them.
FHA financing still has that requirement,
Okay.
but Fannie and Freddie, conventional lending, investment property.
That is huge.
Yeah, it's really big. So for your investors out there, you have an opportunity out there if you're.
I mean, there's condos right now. There's you could buy a house right now in the Denver metro area for under $200,000. Like I've seen it.
Yep.
And when you're talking about COVID prices, when you could buy a condo for under $4,
there was no such thing.
Like that's a big deal. So this has been so informative.
Yeah, well, it's interesting, and this is why we kind of talked about it. Most people out there are not aware. So if you happen to have this information, call Amber, because there's opportunity out there, I think.
Definitely. And if you need creative lending or just a really fantastic lender, we'll get Matt's information below. And if you want to see more videos that help you understand the buyer's market in the South Denver metro area, please be sure to like and subscribe so you don't miss anything.
Thanks, Amber.